something happened to the people who were betting against silver, and it happened while most of the country was asleep. The traders who had sold silver they do not own, the desks that were leaning on this market with borrowed conviction, woke up on the wrong side of a violent move. And if you own silver right now, you probably felt a jolt of something like vindication. Finally, finally, the metal did something to the people who have spent years pushing it around. But I want you to slow down with me for a second, because there is a trap hidden inside that good feeling, and the big trading desks are counting on you falling into it. Here is what I am going to walk you through today, and I want you to stay with me to the end, because the part that actually matters, the part almost nobody on the financial channels will say out loud, comes late. Here is the down payment on it right now. One plain truth you can chew on. The move you just watched happened in the paper market. Not 1 ounce of real silver changed hands because of it. The metal in the vault did not get heavier or lighter. What moved was a bet, a contract, a number on a screen. And once you understand that, you understand everything. Because the thing they do not want you to understand is that silver did not crush anybody. The paper crushed the paper. The shorts got squeezed by other traders, by margin calls, by positioning, by the machinery of an exchange doing what an exchange does. The actual metal, the coins in your safe, the bars in a vault with your name on the account, sat there completely indifferent to the whole drama. And the reason that distinction is the most important thing you will hear this week is that the same machine that just crushed the shorts can and has crushed the longs just as violently. The lever works both ways. Whoever is pulling it does not care which way you are leaning. Let me show you exactly how this machine works, because once you have seen it, you will never read a headline about silver the same way again. I want to take you back to the spring of 2011. Silver had been climbing for months. It ran all the way up toward $50 an ounce, right up to a ceiling it had only touched one other time in modern history, more than 30 years earlier. Every stacker in America was watching. It felt unstoppable. And then, over the span of just a few days, silver fell by roughly 30%. Not 30% over a year, roughly a third of its value, gone in about a week. Now, here is the question the financial press never really answered honestly. What changed about silver in those few days? Did a giant new mine suddenly come online and flood the world with metal? No. Did every factory and solar plant and electronics maker abruptly stop needing it? No. Did the silver in your drawer chemically transform into something less valuable overnight? Of course not. Nothing about the metal changed. Nothing. Not one atom. What changed was the cost of holding a bet on it. The exchange, in the middle of that run, raised the margin requirements again and again in quick succession. Margin is simply the amount of money you have to put up to control a contract. When the exchange raises it, everyone who is holding a leveraged position on silver suddenly has to come up with more cash, right now, or sell. And when enough of them are forced to sell at the same moment, the price collapses. Not because the metal is worth less, but because the paper holders were shaken out of the tree. The exchange did not touch a single ounce. It moved the cost of holding, and the cost of holding moved the price. The metal itself never got the memo. Sit with that, because it is the whole game. The people who run the paper market can make silver look like it is soaring, or make it look like it is dying, and in both cases, the physical metal is a bystander. The overnight crush of the shorts you are celebrating and the overnight crush of the longs back in 2011 are the same event wearing different clothes. Both were paper stories. Both left the real thing untouched. And this is precisely why the big banks and the trading desks are so comfortable letting you obsess over the daily move. As long as you are watching the screen, you are playing their game, on their field, with their rules. So let me draw the line clearly, because everything else today builds on it. There is a paper silver market, and there is a physical silver market, and they are not the same thing, even though they share a price. In the paper market, silver is a contract, a promise, a claim. And here is a fact that should stop you cold. The number of paper claims on silver, the total pile of contracts and unallocated accounts and promises to deliver, dwarfs the amount of actual metal available to satisfy them. There are far, far more ounces owed on paper than there are ounces sitting in the vaults ready to be handed over. For most of history, that gap never mattered because almost nobody actually asked for their metal. They just rolled their bet forward and took the cash. But lately, quietly, That has started to change, and this is the part that should have your full attention. On the exchange, the metal is split into two buckets. There is a large pile that is just sitting there in the warehouse, and then there is a much smaller pile that is actually registered and available to settle contracts right now. And through the recent delivery cycles, that smaller, registered pile has been drawn down hard. Big holders have been standing for delivery, meaning they are refusing the cash and demanding the actual bars. They are walking up to the paper machine and saying, "No, I do not want your promise, I want the thing itself." And every time someone does that, the gap between paper and physical gets a little more dangerous for the people who are short the metal they cannot produce. And you have to understand why this game was ever allowed to work in the first place. A paper contract on silver is a wonderfully useful thing for a miner who wants to lock in a price, or a factory that needs to guarantee its supply cost months from now. That is what these markets were built for. But somewhere along the way, the paper grew far, far larger than the metal underneath it, because you can write a new promise with the stroke of a key, and you can only dig a new ounce out of the ground with years of work and a mountain of capital. Paper is infinite. Metal is not. And whenever you let something infinite set the price of something finite, the infinite thing wins the argument, right up until the day someone insists on the finite thing. That day is when the whole illusion has to reconcile itself with reality, and reconciliations like that are never quiet. Now, let me pause here, because if you are anywhere near retirement, this is the exact moment I need you to think about what you actually own. If your only exposure to silver or gold is a number in a brokerage account, a fund, a paper claim you have never seen and could never take delivery of, then you own the very thing that gets crushed on nights like this. You own the contract, not the metal. And that is a fine thing to trade if you are a trader, but it is a dangerous thing to lean on if it is meant to protect your life savings. Here is what a lot of people your age have quietly figured out, and what the big banks would rather you never learn. Central banks, the most sophisticated buyers on the planet, have been buying physical gold at a record pace, more than 1,000 tons a year, 3 years running, roughly double what they bought the decade before. They are not buying paper promises. They are taking delivery of real metal and putting it in their own vaults, because metal in your own vault cannot be crushed by someone else's margin call and cannot be frozen by another country. And there is a little-known, perfectly legal way for an ordinary American retiree to do the very same thing inside the retirement account they already have. You can move a portion of an existing 401k or IRA into physical gold and silver, real metal, held for you, without triggering taxes and without triggering penalties. It is called a self-directed precious metals IRA, and this is not some exotic thing reserved for insiders and institutions. If you have $100,000 or more in any retirement account, this is squarely for you. I put together a free guide that walks through exactly how it works. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take a look, then come right back, because the next part is where this really opens up. Because here is what makes silver different from almost everything else, and why the paper games are ultimately fighting a losing battle against physics. The world has been running a structural silver deficit for years now, 6 straight years by the most careful count from the industry's own survey, published this year. 6 years in a row of the world using more silver than it produces, drawing down the above-ground stockpile to cover the difference. And that stockpile is not infinite. Every year the cushion gets thinner. The paper market can pretend that does not matter for a day, a week, a quarter. It cannot pretend forever, because you cannot deliver a bar that does not exist. And silver has a cruel little secret that gold does not share. Gold is hoarded. Almost every ounce of gold ever mined still exists somewhere, in a vault, in a ring, in a coin, ready to come back to the market if the price gets high enough. Silver is different. Silver gets burned. It goes into solar panels and electronics and medical devices in tiny amounts, a few grams here, a fraction of a gram there, spread so thin across so many devices that it is uneconomical to ever recover. It gets used up and thrown away. So while the world hoards its gold, it is quietly consuming its silver. And once an ounce is dispersed into a landfill inside a dead circuit board, it is gone for good. That is a supply story no margin hike can touch. Now, let me rehook you, because here is the part that actually changes the picture, and almost nobody connects it to what you saw overnight. While the paper price gets pushed around in New York and London, the real metal has been quietly walking out the door and heading east. There has been a persistent, stubborn premium for physical silver in Shanghai over the price in the West, a gap that says the metal is worth more where it is actually being taken off the market and put to use. And a country that used to be a net exporter of silver has flipped to being a sizable net importer, pulling metal in rather than sending it out. Think about what that means. The paper price can say one thing, while the physical metal, the stuff you cannot fake, is being drained from west to east, ounce by ounce, day after day. The screen and the vaults are telling two different stories, and only one of them is real. And it is not only the metal moving east that tells you the physical market is tightening. The great engine of silver demand, the solar industry, has been forced to use less of it per panel as the price climbed, thrifting and substituting wherever engineers could manage it, the single largest such reduction on record. And yet the metal that thrift freed up has not created a glut because the data centers powering the artificial intelligence boom and the electronics in every modern vehicle have been quietly soaking it right back up. Even with the industry straining to use less, the world still cannot balance its silver books. When demand fights that hard to shrink and the deficit still will not close, that tells you the shortage is structural, not a passing spike. It is built into the way we now make everything. This is the divergence at the heart of everything, and it is the reason a hawkish central bank or a shakeout in the paper market can happen at the very same time the physical metal is getting tighter. The paper price can be under pressure from traders and positioning and a Fed that is leaning hard against inflation, while underneath it, the actual supply of deliverable metal keeps thinning out. That is not a contradiction. That is the entire point. Paper and physical have come apart, and when they finally snap back together, it does not happen gently. So, who is on the other side of this? Who profits from keeping you focused on the overnight tick instead of the underlying tightness? Follow the money. The trading desks make their living on your churn, on you buying the top in excitement and selling the bottom in fear. The financial media sells you the drama of the daily move because drama holds your attention, and attention is what they sell. And none of them, not one, makes a dime when a retiree quietly moves a slice of savings into physical metal, tucks it away, and stops trading. Your calm is their lost commission. That is why the story you almost never hear is the one about paper versus physical. It is the one story that, once you understand it, sets you free from the whole game. Now, I owe you some honesty here, the kind you will not get from a channel that just wants to sell you excitement. Silver is volatile. It is one of the most volatile assets you can own, and the same paper machine that crushed the shorts overnight can turn around and crush the price next month for no reason connected to the metal at all. If you buy silver expecting a straight line up, you will get shaken out, because that is exactly what the shakeouts are designed to do. This is a case, not a guarantee, and nothing I am telling you is personal financial advice. What I can tell you is how to think about it, so the games cannot force your hand. And it comes down to a single idea. Own the metal, not the promise. If you hold the physical thing, or a real allocated claim on the physical thing inside your retirement account, then a margin hike is not your problem. A short squeeze is not your problem. The overnight paper drama is somebody else's fight. You size your position so that a 30% shakeout, the kind we saw in 2011, cannot force you to sell a single ounce. You never ever sell into the panic that the desks manufacture precisely to make you sell. You hold the thing that cannot be printed, and you let the paper players exhaust themselves against the wall of physics. And here is the recognition moment I promised you at the start, the thing I saved for last because it is the part nobody else will show you. Right now, you are early. The smart money, the central banks, the big physical buyers pulling metal east, they already see this. They are already positioned. They are already taking delivery. But the mainstream, the pension funds, the financial advisors, the people who move the trillions, they have not caught on yet. They are still trading the paper, still watching the overnight tick, still telling their clients silver is just an industrial metal with a wild personality. By the time they figure out that the physical market and the paper market have come apart, by the time it leads every news segment and every advisor suddenly recommends it, the easy part will already be behind us. That is how these things always go. Nobody rings a bell. Nobody sends you an invitation. Nobody is going to call you and tell you it is time. The whole advantage of understanding this before the crowd is that you get to act while it is still quiet, while it is still cheap, while nothing feels urgent. And that quiet window, the one we are in right now, is exactly the window that closes first. So let me bring this all the way back to where we started. Silver did not crush the shorts overnight. The paper crushed the paper, and the metal, the real thing, stood there untouched, exactly as it did when the margins crushed the longs years ago, exactly as it will the next time the machine lurches the other way. The daily drama is theirs. The metal is yours, if you choose to own the real thing. If you watch this all the way to the end, you already understand more than most of the people managing money for a living, and I want to help you act on it. I am offering a free, one-on-one, no-obligation educational web conference for viewers with $100,000 or more in retirement savings who mention that they watched this full video. We will look at your actual situation and whether moving a portion into physical metal makes sense for you. There is no fake deadline here, and I would never insult you with one. The honest reason to look now is simply this. The best time to make a calm, careful decision like this is precisely when nothing feels like it is on fire, when you still have the room to think clearly, before the crowd arrives and turns a quiet decision into a panicked one. If you are watching on your TV, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Do it while it is still quiet. That quiet is the opportunity. Do not wait for the invitation, because it is never coming.